How banks make money from debt. Most people grow up with a simple idea of what a bank is, a place where money is stored, a place where paychecks arrive, a place where savings sit quietly. But that picture is incomplete. Banks are not primarily vaults. They are not warehouses for cash. Banks are systems designed to turn debt into income. In this video, we'll explain how that works, step by step, not through hype or fear, but through structure and incentives. We'll look at why debt is so valuable, how interest works over time, and why modern banking depends less on money itself and more on obligations. By the end, you'll understand why debt is one of the most reliable profit engines ever created. At its most basic level, a bank performs one function. It moves money through time. When you deposit money, the bank does not simply hold it for you. Legally and economically, that money becomes the bank's property. In return, you receive a promise that you can withdraw it later, sometimes with a small amount of interest. This is important. When you deposit money, you are not the customer in the traditional sense. You are a creditor. The bank now owes you money. At the same time, the bank looks for people who want to borrow, people who need money now and are willing to pay for that access. The bank stands in the middle. It borrows cheaply from depositors. It lends expensively to borrowers. That difference is the foundation of the banking business. Interest is often explained as the cost of borrowing, but from a bank's perspective, interest is something else. Interest is payment for time. When someone borrows money, they are not just receiving cash. They are receiving the ability to use that money before they have earned it. The longer the time period, the higher the interest tends to be. Banks structure loans so that time works in their favor. A mortgage might last 30 years. A student loan might last 20 or more. Credit card balances may never fully disappear. Each month, interest accrues. Even when borrowers make payments, a portion goes not to reducing the original amount, but to servicing the debt. Over long periods, this adds up. In many cases, borrowers repay 2 or 3 times the original loan amount. Banks rarely lend their own money. They lend money that comes from depositors, investors, or other institutions. What matters is the spread. The bank might pay depositors a low interest rate. At the same time, it charges borrowers a higher one. This gap is small on paper, but enormous in scale. A difference of a few percentage points, applied to trillions of dollars over decades, creates massive profit. The bank does not need to predict markets. It does not need innovation in the traditional sense. It only needs borrowers to continue borrowing and time to continue passing. Cash is static. If you hold cash, it does nothing on its own. Its value can even decline due to inflation. Debt is dynamic. Debt grows. Every loan is a contract that creates future payments. Those payments are predictable. They can be modeled, sold, bundled, and insured. From a bank's perspective, debt is not a risk first. It is a revenue stream first. Risk is managed through interest rates, collateral, and diversification. The goal is not to eliminate defaults entirely. The goal is to ensure that overall interest income exceeds losses. How banks create money? Through lending. One of the least understood aspects of banking is that banks do not need to already possess the money they lend. When a bank approves a loan, it credits the borrower's account with new funds. Those funds did not come from a physical pile of cash. They were created digitally. On the bank's balance sheet, the loan is recorded as an asset. The deposit is recorded as a liability. This process expands the money supply. The key point is this: banks earn interest on money that comes into existence because of the loan. This is not fraud. This is how modern monetary systems are designed, and it makes lending extraordinarily powerful. Not all debt looks the same, but it all serves the same function. Mortgages. Mortgages are long-term and relatively stable. They are backed by physical property. They generate interest for decades. Even small interest rates produce large returns over time. For banks, mortgages are slow but dependable. Student loans. Student loans are unique. They are often backed by governments. They cannot always be discharged easily. They follow borrowers across jobs and income levels. This makes them highly reliable. From a banking perspective, student debt represents future income tied to a person's entire working life. Business loans. Business loans carry more risk, but also higher interest. They are used to fund expansion, equipment, or operations. Even when businesses fail, banks often recover value through collateral or restructuring. Credit cards. Credit cards are the most profitable form of consumer debt. Interest rates are high, balances revolve. Minimum payments extend repayment indefinitely. Many cardholders never fully pay off their balance. From a bank's standpoint, this creates continuous income with minimal additional cost. Interest is the main engine, but fees quietly increase profitability. Fees activate when people make mistakes, miss payments, or miscalculate their finances. Late fees, overdraft fees, penalty interest rates, annual fees. These charges are small individually, but enormous in aggregate. They are also predictable. Banks design systems knowing that a certain percentage of customers will incur fees. This is not accidental. It is built into the model. A common assumption is that defaults threaten banks. In reality, defaults are expected. Banks price risk into interest rates. Higher risk borrowers pay more. Lower risk borrowers pay less. Across millions of loans, losses are absorbed. Collateral further reduces exposure. If a borrower defaults on a mortgage, the property can be seized. If a business fails, assets can be liquidated. The system is designed so that failure does not stop income. It merely shifts how it is recovered. Time is the most important variable in banking. Interest compounds. Fees accumulate. Balances grow if not actively reduced. The longer a loan exists, the more profitable it becomes. This is why banks favor long-term debt. It locks in future income. A single loan may not seem significant, but millions of loans, each producing small monthly payments, create a constant flow. Banks are not built for speed, they are built for endurance. Banks do not rely on excitement or speculation. They rely on contracts, schedules, and time. Debt transforms money into a system that produces income quietly and consistently. Understanding this does not mean rejecting debt entirely. It means recognizing its structure. Debt rewards the institution that issues it more than the individual who carries it. That is not a moral statement. It is a mechanical one. This is how banks make money from debt. Not loudly, not suddenly, but steadily, over time, and at scale.